Hello, everyone, and welcome to the third quarter edition of the UMPIP United Methodist Investment Plan, Personalize and Customize Your UMPIP. My name is Frank O'Brien. I am a Senior Benefits Educator here at Wespath, and joining me today, our special guest, Trent Sparrow, who is the Manager of Impact Investing. The bulk of today will be talking about the sustainability aspects of how we invest at Wespath. Just some housekeeping before we get started. This will be recorded, and we will email this presentation to you, or this seminar to you. We will also provide for you the presentation deck as a PDF for your records. We do have a question box, so you can see on the toolbox on the right-hand side there is a question box. Please take advantage of that, ask your questions throughout. And Bob Christoffel, the Manager of Benefits Education, will be answering those questions. And if we run out of time, we'll be able to print off the remaining questions and get back to you within the next several days. Also on the toolbox, you'll see that we have 5 attachments available to you to download throughout the course of this webinar. We have the Sustainable Investment Report, Understanding Your Investments, Life Stage Personal Investment Profile, UMPIP Contribution Election Form, and Incoming Rollover UMPIP Plan Form. So those are there for your use. And momentarily, Trent will introduce himself as he gets started with his segment for today. For this series, you should be familiar with these faces now. That's myself there on the right-hand side, Bob Christoffel on the left-hand side, Todd Creviston and Cheryl Hatcher round out the benefit education team. To remind you about Wespath Benefits and Investments, we are the largest reporting faith-based pension fund in the world. We are a large organization. We have, this number fluctuates over time, as you can imagine, but we have approximately $25 billion in assets under management. We have over 100,000 participants in our plans. This includes all of us here today, our clergy, lay employees, retirees, surviving spouses, alternate payees, those types of individuals. We are a not-for-profit organization, and you'll hear a little bit about that when we talk about the investment funds, and that we don't have any shareholders, stakeholders that we pay out. The assets stay within us and within our funds for the long haul. We are about caring for those who serve by providing investment and benefit services that honor the mission and principles of the United Methodist Church. For today's agenda, I will provide a UMPIP overview, talk about the contribution options and account access. We've had some webinars where we've spent time talking about the contribution accounts available, some tax efficiency strategies. Account access, life happens. Sometimes you need to access your accounts during the course of your career or ministry, and certainly in retirement. And you can look back at those to get the more extended versions of those. But today, I'm going to kind of go through them more as a refresher. I'll go through the investment options, what I like to call the Wespath family of funds, and then at that point, I'm going to hand it over to Trent to talk about the Wespath sustainable investing and how we approach that. And then I'll, as always, come back to our participant experience, or the resources that we make available to you here at Wespath. As you know, we have a plethora of resources available. So first, what is the UMPIP? Well, it's a defined contribution qualified retirement plan. It's a 403(b) plan. In essence, it's an account balance plan. Contributions are made into an account balance invested in the Wespath funds. There's 2 streams of contributions that can be provided. Certainly your employer can be providing matching or even non-matching contributions. And certainly, and most encouragingly, you yourself are participating in the UMPIP through your personal contributions, and we'll go through those. And then also there is the investment funds, and you can direct how you want your account balances to be invested. We'll talk about how you can self-manage your accounts. You take care of the investment allocation on your own. Or Life Stage Investment Management, a program that we will be reviewing down the road in this presentation. Now, in the Personalize and Customize with UMPIP, these are things that you as a participant, again, you can drive. What kind of contribution type do you want to contribute? You can do the before tax, Roth, and or after tax contributions. You can do a combination of those. And the UMPIP does accept rollovers from other qualified retirement plans. When thinking about the type of contribution you want to contribute, you can think about short-term and long-term tax efficiency strategies. You can defer taxes now and wait until retirement or an in-service distribution for there to be taxes, Or you can pay your taxes up front through the Roth account I'm going to share with you, where you receive tax-free income with distributions later. As far as fund allocation is concerned, we have life stage investment management, or you can self-manage your account if you so choose. And then we have, of course, the sustainable investing approach that we take. And there's certain things that you can do that kind of puts the plan on autopilot. You can do an auto escalation of your contribution amounts. Ask your employer if that's a part of your plan, where you start at a particular percentage and over time it gets to a greater percentage and then levels off, or you yourself commit to do that yourself over time. Again, something we highly encourage you to do. And then life stage investment management is that program where you're asking us to tailor and manage your investment allocation over time. As far as contributing to your UMPIP, well, this plan is available to you upon hire, so you don't have to wait any period of time for you to start to contribute. And you can decide how much you want to contribute to the plan. You can decide on a percentage basis or a dollar amount how much you want to put into the plan on a per payroll or per monthly basis. We highly recommend that you do it on a percentage basis, because if over time you get an increase in your pay, your compensation, at least you know on a percentage basis more contributions will be going into your account. If you fix a dollar amount, you have to remember to go in and up that dollar amount over time. But your choice, you direct how you want that to be. And then you can direct how to contribute it. What type of account do you want to contribute into? And then once contributed into the Wespath funds, do you want to self-manage that, your own allocation of the investment funds, or use life stage investment management? So you decide how you want to structure and contribute and invest in the plan. As far as the contribution choices that are made available to you, there are three. We have the before tax, we have the Roth, and then the after tax. The before tax contribution account we are probably most familiar with. This is where you have a monthly amount of gross pay, and then before taxes are taken, contribution is calculated and put into your before tax contribution in the UMPIP. The contribution is tax deferred and the earnings is tax deferred until retirement or distribution later on. For those out there who are lay employees like myself, just be aware that FICA is taken and then the tax deferral, and then you have the federal and, if applicable, state taxes. For clergy, first the contribution is calculated, then your SECA taxes are considered. And then we have the Roth contribution account. This is an after-tax contribution account, but it provides certain tax efficiency strategies for you in the long haul. Similar to a before-tax contribution, you start with a monthly gross payment amount. We calculate the amount of the contribution as if it was going into the plan, but then all the taxes are taken out, SECA, federal, if applicable, state taxes. Then that contribution amount goes into the UMPIP. And if it's structured correctly, it becomes a qualified Roth account. Then when you take distributions in retirement, that comes out tax-free. For the Roth account to be qualified, it's rather simple. First, you have to be over 59 and a half years old. It's a magic age in the retirement world. You're over age 59 years old. And your very first Roth contribution has to age up 5 years. So as long as that first contribution is 5 years old or older, and you yourself are 59 and a half years old or older, you can take distributions from this account tax-free. Now, one of the reasons why it's called a defined contribution account is because the IRS defines for us how much we can put into the account on an annual basis. So for those under 50 years old, it's $22,500 can go into your before tax or Roth contribution account in 2023. For those 50 years old and older, there's that $7,500 catch-up contribution amount, which then rounds out to $30,000 for those who are over 50 years old, can go into your before tax, Roth, or combination of before tax or Roth contribution. And then in total, including employer monies, there's a limit as to how much can be contributed into the plan as well. It's $66,000 for this year. And we anticipate in about 4 to 6 weeks to be hearing what the 2024 numbers are going to look like. Now, we grant you that $30,000 or the $22,500 is a lot of money, but for those of you who have the opportunity to max out on the amount of contribution you can put into your UMPIP, we have the after-tax contribution account. So let's say you're 10 months into the year, you got to $22,500, you have 2 more years you want to contribute. You can then switch over to the after-tax contribution account, and then going into the new year, switch it back over to either your Roth or before-tax contribution amount. So that tends to be how the after-tax contribution account is used in today's retirement environment. Just to let you know that you've paid taxes on the contribution, so you won't pay taxes on that again. That's double taxation. But with a pure after-tax contribution account, the earnings on that will get taxed when you distribute that money as either an in-service distribution or retirement income. The United Methodist Personal Investment Plan, our personal investment plan, does accept rollovers from other qualified retirement plans or arrangements. So other 403Bs like RPIP, 401Ks, governmental 457 plans, traditional IRAs. You can take those sitting somewhere else with a prior employer or in a traditional IRA and then consolidate that into the PIP plan for better management of the account over time and then distribution options that get made available to you in retirement. We have a very simple process here. Cheryl Hatcher, whose picture you saw earlier, manages our rollover in process. There's a form that you complete, and she will work with the current holder of that retirement account, do what we call a direct rollover into the UMPIP, and get it invested as per your investment choices in the Wespath funds. And because we handle it that way, it is a non-taxable event to you. So we take care of it behind the scenes, and then you're consolidated in the PIP. As far as accessing your account, we do recognize that life happens, so although this is designed to be a retirement plan that's going to provide retirement income over time, we do realize there's going to be times in your life where you're going to need to be able to access that account. So you can get at it prior to retirement or termination, certainly upon separation of service, and at retirement. We do have a loan provision in the personal investment plan. So if you find yourself in a situation where you need to access some of your retirement plans to fix the new roof or what have you, you don't necessarily have to take a distribution with a taxable event. You could take out a plan loan, pay it back to yourself at a rate of interest. All of that goes back to you, invested in the Wespath funds, and you can take those loans as opposed to actually taking out a distribution. For those under age 59 and a half, we do have a hardship withdrawal option. There are qualifications that you have to satisfy before you can take a hardship. Call our Participant Solutions area. They will help you with that, and you can take out a distribution. Just be mindful, it's taxable with a 10% penalty if you're under age 59 and a half. If you're over age 59 and a half, it becomes an in-service withdrawal where you still have it as a taxable event to you by taking that distribution, but that 10% tax penalty is no longer present. Again, 59 and a half is a magic number. You roll over money into UMPIP, you can go ahead and take a distribution from that. The taxes are determined whether or not you're 59 years old or not. And then we have provisions for people going on disability, people with qualified military service. We have those types of withdrawals. If anybody is thinking about taking a withdrawal from their plans due to something like that, again, please call our Participant Solutions area, and they will help you think through and work out that distribution. And also, probably the first shout out today for EY Financial Planning Services. If you're not sure about a loan or a withdrawal that you need, please call EY and you can work that out with them as well. As far as separation from service is concerned, the clergy person, they must terminate conference membership for it to be a separation from service. For a lay employee, you can move on to another employer. The money's portable to you. You could roll it out to another employer. That's if you leave your plan sponsor employment. But if you go to another qualified or eligible plan sponsor within the UMC or related denomination and stay in the Wespath retirement plans, you can do so as well. And of course, retirement. In retirement, we provide you with a lot of options, a lot of flexibility as to how, when, and how much income you want to derive from your accounts through retirement. You can take a full lump sum distribution if you choose. You can take a partial lump sum distribution if you choose. For those who are clergy, we always caution to be mindful of the housing allowance tax exclusion that you enjoy in retirement. So if you take out all of that money, you want to work with your financial advisor, your tax preparer, to understand what the short-term and long-term consequence of that might be. And then you can set up cash installment arrangements. You can self-manage how you want to receive those installments over time. Tell us $800 a month and we'll do so. Or you can use a program we call Life Stage Retirement Income, where you're asking us to derive the amount of monthly installment payments for you over time. You can always leave it on account and defer receiving any of that income, but upon the attainment of age 73 this year, then you have to take a required minimum distribution. And this information was provided in the second quarter UMPIP webinar that we did. And somewhat uncommon in the retirement world is that even though you retire from the plan here, you can still take out plan loans in retirement. That's something in the secular world that you never really hear of. And then investing in your account. And as I said, I'm going to go through and refresh us on the investment funds, and then our special guest, Trent, will take us into the sustainable investing approach. And you can see that as our first bullet there, and it's always our first bullet there. Sustainable investing really means two things. First of all, sustainability over the long haul. We have been doing this for 115 years, and we have every intention of doing this for a very, very long period of time. But we also do it in a way that upholds the values of the UMC. So it's got to be held up for the long haul and under the principles of the denomination. We have a diversified set of investment funds. You're going to hear about capital preservation, income funds, equity or stock funds that we're going to review. We have competitive returns relative to benchmarks. We do measure our fund performance against like funds or peer funds in the marketplace to ensure that we are managing our investments in conjunction with how the marketplace in general is also investing in those types of funds or securities. We are a not-for-profit organization, like I said. We are not paying out anybody for any work that they do by bringing in new business or selling any products. So we don't have any commissions being paid out to anybody on our staff. And we have low expense ratios. We are a large organization. $25 billion gives us economy of scale, which means we can kind of suppress the amount of expense ratios that we take out of the funds. And those expense ratios is what pays the overhead for Wespath. Everything from staff to the pens and pencils to life stage retirement income, life stage investment management, EY financial planning services. And we'll talk about life stage investment management shortly. Just to go through the funds that are made available to you, and they by category or class. We have the Stable Value Fund. That is a capital preservation fund. The words are kind of telling us what's happening here. The idea of the fund is for it to be invested in a very conservative way with not too much risk to get not much return, but some return over time, but really to ensure that the capital, the investment, is as protected as it can be. And this is where it gets into retirement strategies when you talk to EY and your financial planners to how best to position this fund in your portfolio. We have 3 income funds or bond funds. We have U.S. government bonds and corporate bonds, international bonds, all kind of coming into play here across the spectrum. We have the Inflation Protection Fund. The idea of this fund is to help us keep pace with purchasing power over time. So it's looking at the rate of inflation in the domestic economy and looking at the securities that we can purchase to help us, again, maintain that purchasing power over time. So that's really the kind of the goal of what the income is we're trying to derive from that fund. We have the Fixed Income Fund. This is a broad array of different types of income instruments that can go into the fund. And because of that, there's more risk associated with it. So we have government bonds, international bonds, some corporate bonds, some agency bonds, those types of instruments that are in there. And because of the broad nature of it, the diversification nature of that, there's a little bit more risk with a little bit more potential rate of return. And then the last one is the Extended Term Fixed Income Fund. And this is a bond fund that is on what they call the long end of the bond spectrum, like those 10-year bonds and 30-year bonds that we hear about in the media all the time. We're investing in those primarily for this fund. Nobody knows what interest rates are going to look like down the road, so there's a higher rate of risk relative to investing in these types of securities with a higher potential rate of return. But still, income funds as they are invested with the goal of providing income. And then on this screen, I'll direct your attention to the bottom first. We have the 2 equity funds, stock funds, company stock funds. And again, the words are kind of telling us what's happening here. We have the U.S. Equity Fund. So we're buying domestic U.S. companies, but not just the big companies like the Apples of the world. We're buying large capitalization funds, mid-size and small-size companies to put into the fund, and what they call growth, kind of like those technology funds we hear about a lot, and also what they call value funds, where we're trying to identify companies we think are undervalued, bring them in, and try to get a lift off of that as far as fund performance goes. So equity funds, U.S. equity, certainly a higher degree of risk with a higher degree of potential rate of return. Then we have the International Equity Fund. Same thing, except that we're now bringing in international companies. It's not US-based companies, but global companies like Siemens and Sony, those types of companies that come in and make up the International Equity Fund. But again, it's not just the big names that we know. It's the large ones, the mid-sized ones, the small ones. This growth and value concept that I briefly touched on all gets blended into this fund as well. International, by its nature, adds a little bit more risk to it, so a little bit more potential rate of return, but certainly probably the riskiest fund on the scale that we have. And then we have what we call the Multiple Asset Fund. It's a balance fund. This fund is actually designed to be baked into the diversification to have 65% of the fund be invested in equities and 35% of the fund be invested in the income side, the bond funds. And the way we do it, I think, is very smart. It's a fund of funds. So we're using the investment funds that I just reviewed with you and then developing the multi-asset fund by using them as the underlying means to develop the multiple asset fund. Because we do it that way, we're constantly making sure that the funds themselves are operating the way we want them to, and therefore the multiple asset fund, just by nature, should also be operating the way we want it to. We have the Social Values Choice Suite of funds. This is for participants with a heightened focus on companies' environmental and social performance. So the sustainability that we're going to be talking about momentarily kind of gets into this. This is where certain types of industries or companies or even countries we intentionally do not include in any developments of these funds, and that's kind of based on decisions of annual conference and other agencies within the UMC. As I said, there's some risk and return considerations in the types of funds that we have. You can see with the risk and the return, the lower left-hand side there, the Stable Value Fund, capital preservation. Not intended to take on a lot of risk, but you're not going to necessarily get a real big return out of that. But as you go up to the right, you can see the Fixed Income Fund. Again, it's an income fund, it's a bond fund, but it's got a larger array of types of securities in there, adds more risk to it with a more potential rate of return, all the way up to the International Equity Fund. Now, this is a long-range view of things. This is what history tells us, but we know from the pandemic, we know from the inflation from last year, these can always get flipped over in the short term, but over time, these balance themselves back out to that type of risk and return model. We've talked about EY Financial once or twice already. Great resource for us. I'll touch on them at the end. They're right there in the middle of this screen. If you're not quite sure how you want to do your investments, or even if you want to self-manage your investments, it's always a good idea to pass this by EY in advance, just to talk it out to get a higher degree of comfort. You can choose your own mix of investment funds, where you're saying I want X percentage of my account to go into this fund or that fund, or you can use Life Stage Investment Management, where you're asking us to derive the investment allocation for you through the long haul. The way Life Stage works is we look at you as an individual. Are you married? What's your expected benefit commencement date? What's your age? We anticipate Social Security benefits unless you tell us otherwise. We also look at your Wespath benefits to see what kind of income may be derived from other benefits that you have. And then we look at your risk tolerance. And you can tell us on this Life Stage Personal Investment Profile form I put there that what's your risk tolerance? Are you conservative? Are you moderate? Or are you aggressive? If you don't tell us, we're going to default you to a moderate risk tolerance. Once we derive all of that about you, we then tailor your fund allocation for you. And again, we're doing this over the long haul. And we do it in two ways. The first thing we do is we look at your age. And for example, let's say you're at 70% equity and you're 30% fixed income. We look at you and say, this is where we want you to be relative to the investments in the Wespath funds. But as we age up, the amount of equity exposure comes down, the amount of fixed income exposure goes up. We always need to have equity in there for that growth, for that potential. But we also need to, as we get closer to retirement, have more income in there because we will be paying income stream to you through your retirement. The way we also do it, and the second level, is we're looking at you 4 times a year. So we're doing it for the long haul, but we're not just setting it and forgetting it. We're looking at you and we're saying 4 times quarterly based on your birthday, so quarterly off your birthday, where are you and where do we want you to be? And if you're not where we want you to be, we will reallocate or rebalance the account for you. So if you went from 70-30 to 80-40, well, we're going to sell off that additional 10% to get you back to 30. If you went to 60-40, same thing. We're going to start to shed some of that income side to get that down and bring up the equity side to get that back to where we want it to be. And because we do it that way, history tells us that there is a marginally higher potential rate of return in the way you're investing with us because of the way we're actively managing that over time. Again, we have the investment profile form that is there. Many people, part of our participants, just default into life stage investment management. And again, we put them at a moderate risk tolerance. You can see how you've been allocated on benefit access, under account summary, investment funds. You can find out if you're in life stage investment management and how you're in life stage investment management. And then you can always make that change to your risk tolerance or your benefit commencement date if you so choose. So a very powerful program, again, doing two things at the one time to really manage that account over the long haul. We have a lot of information on wespath.org. You can hear more about it at the end, but as far as the investment funds are concerned, you can get executive summaries, you can get detailed information, you can get those benchmarks and comparative results, you can see our operating expenses, our fees, and all of that. So that information is most definitely there available to you on wespath.org. And so now it is my pleasure to introduce, again, Trent Sparrow, Manager of Impact Investments, our special guest for today, to walk us through all of these things we talk about every time we talk about UMPIP and sustainable investing.
Thank you,
Trent?
Frank, for that nice introduction. As Frank said, my name's Trent. I am the Manager of Impact Investments here at Wespath, and I appreciate you all taking some time this afternoon to spend some time with us, and particularly to hear about how Wespath leads in the area of sustainable investment. Our agenda for today's conversation is pretty simple. We're going to talk about how Wespath does sustainable investing, and then I'd like to provide some examples of how we're investing sustainably and how we're engaging sustainably. Before I get started, one thing that I like to level set with everyone is when I'm talking about sustainable investing at Wespath is we are first and foremost guided by a fiduciary duty. And what that means is we put our participants and our institutional clients first in everything we do when it comes to investing. The Book of Discipline also outlines a charge to make a conscious effort to invest in alignment with the social principles of the United Methodist Church. And we believe that those are not mutually exclusive directives. They are to work together. And we truly believe that investing in a sustainable way creates long-term shareholder value creation for everyone. So I'm going to take a step back real quick and talk about how investing sustainably works at Wespath. As you can see on this slide, we have both institutional clients and participants at Wespath. What we do is we take money from both of these parties and we invest that money into stocks such as the ones that you see listed here. And the goal of investing in these stocks is we want to create long-term value. We want to increase participant account balances. We want to make sure that our institutional clients have the money that they need to fulfill their missions. One way that we feel like we can create long-term value for our participants is through investing sustainably. We believe that investing in a sustainable manner honors the values, mission, and traditions of the United Methodist Church. We also believe that intentional integration of ESG or environmental, social, and governance factors and the selection and management of investments positively affects long-term performance. And lastly, we believe that engaging with corporations is an extremely powerful process and one that we do on your behalf as participants in our funds. At Wespath, we have a vision for what sustainable investing is, and we call that our Sustainable Economy Framework, or SEF for short. That vision is centered in three principles. The first is social cohesion, the second is long-term prosperity for all, and the last is environmental health. Now, we believe that if we can create an economy where there's social cohesion, economic prosperity for all, and environmental health, we'll be able to invest in that economy and create long-term value for all of our participants. Now, these are pretty lofty goals, and often I get asked, how do we achieve those goals? Fortunately, at Wespath, we have our sustainable investment framework that's centered in 3 levers that we can use to achieve that broader sustainable economy framework, that vision. And there are invest, engage, and avoid levers. On the investment side, we can work with our external asset managers. The example that I like to provide is when I started working at Wespath 11 years ago, I had many friends reach out to me and say, hey, which stock should I buy? And I had to tell them, like, hey, I'm not the person that's making the day-to-day buy and sell decision on stocks. Wespath actually hires professional investment managers to do that on our behalf. And what we do on the sustainable investment team is we engage with those asset managers to make sure that they're integrating environmental, social, and governance into the way that they're investing on our behalf. We also have our positive social purpose lending program that I'll go in more in depth later on in this presentation, where we're investing in multifamily affordable housing across the country. And lastly, we have our low carbon energy solutions that we're investing in the public equity side of the business. The second lever is engagement. We engage through the proxy voting process. And if you're not familiar with that, basically what that means is, as a shareholder in a company, you have a right to vote on how that company is operated every single year through a company's annual general meeting, or AGM. And at those meetings, they put out a ballot of items that need to be voted on. And as a shareholder, you can vote on those items. And at times at Wespath, if we feel like a company's not engaging with us, we may file what's called a shareholder resolution, an item that gets included on that proxy ballot. Most of the time, we engage with corporations on specific topics, and I'll provide a few of those examples later. At times, we also engage with policymakers, and as I mentioned previously, we do file shareholder resolutions when we feel they're necessary. And lastly, we have our avoid lever, where we live into the social principles of the United Methodist Church through our ethical exclusion and our financial risk exclusion. And these are sectors of the economy that we don't invest in because we don't think they're in alignment with the UMC social principles. So to jump into a few examples here, we have several examples that we could talk about. And I'm just going to talk about one in each of the environmental, social, and governance areas listed here. The first one that I'd like to talk about is Occidental Petroleum. And if you're like me, I didn't know that Occidental Petroleum was one of the big oil and gas majors here in the US. And a few years ago, a colleague of ours started engaging with this company and asked them to create a report that would highlight how their company would handle a transition to a lower carbon economy. So as individuals and companies are becoming less and less reliant on carbon emissions to go throughout their daily lives or generate revenue through those businesses, we just wanted to know how Occidental Petroleum's business would be impacted and how they were kind of future planning about this. And so we engaged with them over time and realized we weren't really making much headway. And so we decided to file a shareholder resolution asking for this report. The first year that we filed this resolution, we got single-digit support for it, and it was just enough that we could file it again a second year, which we did, and we got incrementally more support, and then we filed it again a third year. And in that third year, the resolution actually passed, and there's a quote from the Wall Street Journal that highlights how this was one of the first times a resolution like this had been passed in the oil and gas industry. And that was directly correlated with the work that was happening here at Wespath in the Sustainable Investment Team. On the social side of things, I think if you're like me, you like chocolate. At Hershey's, I like to highlight this one, the Dove chocolate brand that many of us are familiar with. That was Hershey's first 100% fair trade cocoa sourced chocolate line. And that, if you're unfamiliar with how cocoa is sourced, it can be a supply chain that's often fraught with child labor or individuals that aren't fairly being compensated for the work that they do. And so we engaged Hershey's, and they committed to sourcing 100% of their cocoa via fair trade sources by 2020. And that Dove chocolate line was the first step in that direction. And on the governance side, when I think of governance, this is basically how companies are run. And what I like to highlight here is in the bottom corner of your screen, you'll see that board diversity box. That's where we work with the Midwest Investors on Diversity and the 30% Coalition to try to encourage board diversity, because many research studies have shown that companies with more diverse boards tend to perform better in the long term and create more value for their shareholders. And through that work, we've been able to influence board diversity at several companies. Moving more specifically on an engagement that I think many of us are familiar with in various ways. In this country, we're facing an opioid epidemic. And here on the slide, you feel free to kind of glance through the stats. These are the numbers side of that epidemic. But what I like to talk about is one of our colleagues here, he actually penned a blog on our Investments Insight blog, where he shared some very personal details about a cousin of his that was a victim of overdose of opioids. And that is why we're engaged in this work. We recognize that engaging on this very important topic of opioid use in the country is so important. And we're actually a member of the Investors on Opioid Accountability here in the U.S. And one of my colleagues, Chirag Acharya, is actually a co-chair of that investor coalition. And what they've done is they've engaged with many of the large drug makers in the country to make sure that, first and foremost, that there's a separation of board chair and CEO at these companies so that the boards can hold the companies, the executives at these drug companies accountable for their actions. They've also pushed to have executive compensation packages at these companies to not have exclusions for legal costs, where an executive can say, hey, we did great, except for these legal expenses associated with the opioid epidemic. We're pushing for companies to make sure that those legal costs are included and they are used to calculate how well a company performs over a year. And those are just a couple of examples of tangible things that the Sustainable Investment Team has been engaged with here at Wespath. Another area where we've engaged in the service of our social cohesion pillar of our sustainable economy framework is on human rights. And again, my colleague Chirag Acharya actually filed a shareholder resolution at Caterpillar asking them to address how they're handling human rights. I think some of us are aware of Caterpillar's activity in some areas where there's a higher level of conflict, and such as Israel, or their involvement with equipment in Ukraine, or as it's highlighted here on this slide, they're sourcing clothes from a factory in China that's used coercive labor. And as we had conversations with them, we didn't feel like they were really staying at home on risks that may materially impact their business related to human rights. And so we filed the shareholder resolution asking them to generate a report and at a reasonable cost to let investors know how they're dealing with human rights at their company. Another area where we've engaged policymakers is on methane. A large emitter of greenhouse gases is gas pipelines and methane. And what we've done is we've encouraged lawmakers to make sure that there is proper leak detection in these pipelines, similar to what's already been implemented in western states such as Colorado and New Mexico, to make sure to the extent that there's leaks in these gas pipelines that they're found early, they're taken care of, and to make sure that companies that are managing these pipelines are staying at home on this business so that those emissions don't go into the atmosphere. Other areas where we've had influence or success in influencing our business partners is engagements with our asset managers. As I mentioned earlier, we continually work with them on a consistent basis to make sure that they're integrating ESG into our investment process on our behalf. One that I'd like to highlight here is actually our work with BlackRock and how we've worked with them to implement low carbon investment themes. We have here our investment belief as it relates to the low carbon transition. We believe that the world is transitioning away from carbon intensive sources of energy and trying to implement more renewable sources of energy, EV cars, etc. And that process, that transition away from a carbon intensive economy, that process would create some winners and losers. And to that end, in 2016, we invested with asset managers Impacts in Wellington that have dedicated strategies to take advantage of that transition to a lower carbon economy. And then on the passive side of the business, or the side of the business where we invest in stocks on not an active basis, but passive, where we're buying pretty much the whole market, with the exception of our exclusions, we partnered with BlackRock. And BlackRock is one of the biggest asset managers out there to create what's called our transition ready strategy. And what that does is it's still a passive strategy, but it takes a look at the whole investment opportunity set and slightly overweights companies that are better prepared for a transition to a lower carbon economy, and slightly underweights companies that may not be as well prepared. And we began that strategy in 2018, and in 2019 and 2021, we rolled that strategy out to additional passive strategies and into international markets. I'm going to touch on our impact investing themes, my area of expertise. As you can see here, we have many different themes that we're focused on. The one that I'm probably going to spend most of the time on today is our affordable housing strategy, and that's through Wespath's Positive Social Purpose Lending Program. Now, I mentioned earlier that I'm not the one making day-to-day buy and sell decisions on stocks. However, there is one internally managed investment strategy here at Wespath, and that is our Positive Social Purpose Lending Program. This investment strategy has been around since 1990 and was born out of a directive from our board of directors that we needed to do something about the housing crisis. Back in 1990, the program was seeded with $25 million through an initial investment. And since then, we've invested over $2 billion into affordable housing in all 50 states, and even Puerto Rico. And the whole goal of this program is to create needed multifamily affordable housing, support local jobs and communities. Also through this program, we've done some international microfinance, which are small loans to entrepreneurs in emerging markets to help them support and grow their businesses. To give you a little bit more in-depth understanding of kind of the properties that we invest in, I'd like to highlight the Abigail Apartments in Lansing, Michigan. We invested $713,000 into this property, and it's focused on individuals that are 55 and above. There's 60 units, and it's actually located on the campus of the former Michigan School for the Blind. And as you can see here in this picture, this is a historic building that was built. The administrative building was built in 1916 with a high school that was built in 1912. And what the developer did on this property is they went in and did a historic adaptive reuse of this building to create these beautiful 60 units for individuals 55 plus. And these are well-appointed units that people are going to be able to live in for many years, and that are going to continue in the affordable housing stock in this country and really address a need in Lansing, Michigan for affordable housing. Lastly, I'd just like to finish up talking about our investment exclusions. We do have our ethical exclusions that are directly related to the social principles that don't allow us to invest in companies whose core business are alcohol, tobacco, pornography, gambling, private prisons, and weapons. Additionally, we have our sustainability risk exclusions, and those are exclusions that are centered in our understanding of not investing in certain sectors that may have heightened risks that make it that the risks associated with investing in those sectors doesn't make the financial return make sense. And again, what we've seen over all the time of investing, these exclusions don't materially impact performance for our participants. I'm going to hand it over to Frank to finish up talking about participant resources.
Thank you very much, Trent. And I don't think it's an overstatement to say that we truly have been a pioneer in all of this sustainability investing, ESG, social awareness and all of that. So certainly something that we're all very, very proud of.
Yeah.
As far as participant resources is concerned, and we go through this often, there is a tremendous amount of resources for you. And in all honesty, right now, you've just experienced some of the resources that we do make available. And what I would like to point out is the idea to have the session that we had today came from you. Periodically, we send out surveys as to how you're perceiving the series that we're doing for UMPIP. You give us your ideas and suggestions, and this really kind of materialized from some of the ideas that you have provided to us. So at the end of the year, you'll get another one. Anybody who registered will get another survey. So please continue to give us your ideas because they do materialize into segments that we do share with the broader population. So we have benefit access. Hopefully all of you are registered with benefit access. If you are not, please go and register. It doesn't take that long. The usual type of ID, password, authentication, all of that. But you can get the information on your accounts and educational materials at benefitsaccess.org. You can get your current account information. You can get your quarterly statements and any tax forms that you may need. We have tools, projection tools. You can run a projection. You can do some readiness or gap analysis. All the investment information that's there for you. Beneficiary designations. We didn't talk about that yet, but always take a look to make sure that they are in good working order. Something tragic happens to you, you and your spouse, you want to make sure that those who you want to receive will receive in a timely fashion. EY Financial Planning Services. This is a great partner that we have. They provide holistic household financial planning services for you. They can speak to you about individual financial questions you may have. Do I buy a car? Do I lease a car? But they can certainly help you with the larger planning that you may have in terms of the types of contribution accounts you want to contribute today, how you want to use our investment funds, and how you want to start doing gap analysis and planning for future retirement income from them. On their website, wespath.eynavigate.com, more tools, more educational resources for you to continue to think through the short-term and certainly the long-term aspects of using EY. And there's no out-of-pocket expense to you. As I explained, with the operating expenses and the overhead, that comes out, and that's how we pay for the EY relationship. So no out-of-pocket expense. Your investment is your time. Give them everything they need, and they can run some good long-term financial planning for you. Again, they can do the retirement plan. They can help you think about children's, grandchildren's education type of funding, 529 plans, those types of things. Do you want to use life stage investment management? Do you want to use life stage retirement income? How about the tax efficiency strategies? Clergy with Roth, maybe it doesn't make sense because of the housing. Lay employees, maybe it makes better sense. So speak about that with EY, and they can certainly help you with that, and much, much more. They have a quarterly webinar series or a monthly webinar series similar to what we're doing. So in September, get more out of your savings plan, which is kind of nice because we're kind of doing that too. And through all of this, we're encouraging people to continue to contribute and increase contributions into the PIP. In October, there's going to be a session on the health savings account. This is also timely because annual election, either in HealthFlex or other health insurance plans you may be participating in. Certainly, if you have a high deductible health plan involved in that, understanding the health savings account will be helpful. And then in November, everyone needs an estate plan, which is good. So that's the November session for EY. And in December, again, suggestions we've gotten from you and your surveys, we're going to have Dan Eck participate in the fourth quarter December UMPIP webinar to talk about financial planning and the long-term thinking that goes into that. So very excited about our next webinar in our series. We do the one-on-one benefit education consultations. That's Todd Creviston there. You can see on the screen. There's that link, wespath.org/r/consults 23. You get a half-hour consultation with one of us benefit educators. We'll go through your individual circumstance, explain to you what plans you're in, how they operate, the options that you may have. We think it's a good idea if you're going to speak to EY or your own financial planner to set up one of these consultations so you can really kind of get a picture of what's happening and you can formulate the questions in advance that you want to ask them. So this has been a very successful program. We're on our third year right now. We do hundreds of them during the course of the year, and we truly enjoy doing these. So please take advantage of that resource made available to you. As far as action steps are concerned, if you're not in UMPIP, enroll in UMPIP. If you're contributing and you think you can contribute more, consider contributing more. We understand cash flow problems or issues and considerations along the way, but certainly the more you contribute, the better off down the road. Certainly if you're getting an employer match, you want to contribute up to the employer match because you don't want to leave any of that employer money on the table. Think about how you want to use the Wespath funds in an investment strategy, life stage, or self-manage, again, back to EY. You have benefit access, you have EY, you have our one-on-one consultations, you have our participant solutions area, you have EY benefit access. It gets a little redundant, but I can tell you that we truly enjoy supporting our participants here at Wespath. We have a lot of ways to do that, and we certainly hope to engage with all of you over time to help you think through, plan for, and then enjoy your future retirement. And then with that disclaimer, that concludes this webinar. We thank you very much for your time and consideration, and we look forward to seeing you again in December. Thank you, and have a nice day. Trent, thank you very much for being with us today.
Thanks for having me with Frank. Thank you.
Well, it was fabulous.